Money market versus capital market, what's the difference? The money market and the capital market are not single institutions but two broad components of the global financial system. The money market is the trade in short-term debt. It is a constant flow of cash between governments, corporations, banks, and financial institutions, borrowing and lending for a term as short as overnight and no longer than a year. The capital market encompasses the trade in both stocks and bonds. These are long-term assets bought by financial institutions, professional brokers, and individual investors. Together, the money market and the capital market comprise a large portion of what is known as the financial market. The money market is a good place for individuals, banks, other companies, and governments to park cash for a short period of time, usually 1 year or less. Key takeaways: the money market is a short-term lending system. The capital market is geared toward long-term investing. Companies issue stocks and bonds to raise money to grow their businesses. Institutions operating in the money markets include the Federal Reserve, commercial banks, and acceptance houses. When a company or government issues short-term debt, it's usually to cover routine operating expenses or supply working capital, not for capital improvements or large-scale projects. The money market plays a key role in ensuring that banks, other companies, and governments maintain the appropriate level of liquidity on a daily basis, without falling short and needing a more expensive loan and without hoarding excess cash that isn't earning interest. Individual investors may use the money markets to invest their savings in a safe and accessible place. The capital market is where stocks and bonds are traded. The overriding goal of the companies' institutions that enter into the capital markets is to raise money for their long-term purposes, which usually come down to expanding their businesses and increasing their revenues. They do this by issuing stock shares and by selling corporate bonds. The capital market is roughly divided into a primary market and a secondary market. A company that issues a round of stock or a new bond places it in the primary market for sale directly to investors or institutions. If and when those buyers decide to sell their shares or bonds, they do so on the secondary market.